that we have analyzed volatility of the exchange rate in the short run, we are ready to switch to try to understand what determines long-term movements of the exchange rate of the kind that we have seen at the beginning of this lecture. Think about the exchange rate between the US dollar and the yen that went up considerably over the last 40 years. What's behind that? The simple theory we're going to introduce is known as purchasing power parity theory, and it's based on a simple idea. If competitive markets prevail, at least in the long run, then it should be true that the price of a basket of goods should be the same across countries after we convert the price of this basket of goods in a common currency. Why is this true? Well, think about what would happen if the cost of a basket of goods was higher in our country compared to abroad. Then two things would happen if competitive forces are at work. First of all, we are going to import more of this basket of goods from abroad. We know from our lessons on the balance of payments that when we import something from abroad, we need to demand more foreign currency. When we demand more foreign currency, then the exchange rate between our currency and the foreign currency will go up. Second of all, foreigners will not demand much of our domestic basket of goods, meaning that there's a lower demand for our domestically produced basket of goods, which will drive down its price. But then we have that the exchange rate between our currencies is going up and our domestic price is going down, which are both two forces that contribute to restore the equality in cost between our domestic bundle of goods and the bundle of goods produced abroad. This simple theory is known as purchasing power parity theory, and we're going to make the hypothesis that and evaluate the hypothesis that this theory is behind those long-term trends in exchange rates that we observe in the data.